Hey everybody, this is Justin Bogart. It's Wednesday, March 8th, 2023, and this is the Real Estate Note Investing Be the Bank broadcast brought to you by American Note Buyers. And so today we're going to be discussing retirement accounts, kind of different types of accounts and what you can do with them and kind of how they work. And also in the market today, in the mortgage market and the home markets, seeing how pricing is doing month over month, year over year. And also, would you believe this, that there are markets, large markets here in the United States that actually have a inventory supply that is an oversupply. Can you believe that? Stay tuned. Mr. Thornton, how are you?
Pretty good. How about yourself?
Pretty good. Getting the swag on, starting to wear all the
Good,
swag that
good,
we got going for
good.
American Note Buyers.
Good. I tell you, every time I hear that opening music, it gets me going, makes me want to listen to what we're going to say, or that's good stuff. I like it.
On the East Coast here, it's 6 p.m. So
Mm.
it's after work. We got to, get things going so we can make it to whatever Netflix or, Amazon Prime or Peacock shows that we're going to watch later.
That's right.
So it's March here. The weather is getting warmer. We've pegged a couple of 70-degree days here in 2023 in Indianapolis specifically, which is kind of uncommon. We usually hit close to that, like maybe once, but there's been 3 or 4 days so far that have been at least 60 plus, and 2 of them at least got to 70.
Wow. Well, it's nice here in Northern California, but it just does not want to stop raining. I mean, it is nice right now, but we're queued up for yet a third set of storms, as they call them, river flow. I can't remember what they call them, but anyway, it's kind of amazing. Who can complain about getting too much water in California, right? But
yeah, you had mentioned that before, one of the podcasts that we recorded not too long ago. I think it was a couple weeks ago, that it had been raining for a while too. Is this unseasonally wet time?
This is breaking all records. This is easily breaking 100-year records.
Wow.
Yeah.
All right, guys, those of you that are watching the broadcast here live, you can chime in whenever you want on any of the social media platforms that we are streaming on currently. You can shout out and say hi or where you're from. We'd love to hear from you. And if you have questions about what we're going over today and talking about, feel free to chime in anytime. We may bring up your comment during the presentation. We might wait till towards the end when we have more of a conversation, a Q&A that Richard and I have at the end. So without further ado, Richard, I think we're going to transition over to the good old PowerPoint.
Good deal.
Yeah. If I can get my slides going here. So this is always a challenge, trying to find where the mouse goes on the screen, and then you have these lights that are coming in at your eyes. So I'm looking over there, and I have a blind spot for a second, and I have to kind of take a minute for my eyes to dilate. So excuse me.
Gotcha.
We're not having everything there complete. All right. So our sponsors for today's broadcast are always American Note Buyers here. If you email the operations at anbfunds.com trade desk, you can find out where you can sell us deals or you can buy deals from us as well. Real estate education is done none other than by CYREA. That is our Central Indiana Real Estate Investor Association. They are a sponsor here for American Note Buyers, Be the Bank. They call it a subgroup. It's part of their training and education for people in the local real estate community that are part of Indianapolis. And actually, we have members outside of Indianapolis as well. You can reach out to our executive director, and the phone number is on the screen there for you. Note investing training. This is something Richard, myself, our friends Larry and Mariska also put together. Richard, I think this was 2020 when we put this together.
Mm-hmm.
And so if you email info@anbfunds.com, we can get you information on how you can sign up or pay for the constant cash flow training course. It's like foundational knowledge for you to get either familiar with note investing at a very minimal cost, or if you've done a couple of deals, it's a great refresher, or maybe you'll pick up a few little tidbits that you didn't know already. It's pretty helpful. We had a lot of great feedback from it, so we encourage you guys to hop on and do that. Our trust company, that is a self-directed IRA company, is a sponsor as well. They're called New View Trust Company. They're out of Florida. And if you email newaccounts@newviewira.com and you mention this broadcast, they're definitely going to waive your setup fee. So if this is going to be a good, I'm going to say episode, this is a good broadcast for today. Are you waving at me?
I'm waiving the setup fee. I'm waiving it. You know?
Yeah. I thought you were like swatting at a fly or something.
No. It's a setup fee. I'm moving it away. Get out of here.
Get out of here. We don't want you to set up fee. You're disgusting.
Get out of here. Get out of here.
Right on. Anyways.
Yeah.
That's that. Those of you that are part of CYREA that are watching this live or the replay of this, don't forget they have a Facebook, they have an Instagram page, they have a LinkedIn page as well. They have a nice YouTube channel for anyone that wants to follow them, CYREA. And they're just a wealth of knowledge. They have some great resources there. Outside of note investing, they got a ton of great resources for if you're a landlord, a short-term person, wholesaler, a fix and flipper, or if you're just looking to have better contacts here in the Midwest and the Indianapolis area and surrounding places. It's a good place to be a part of our membership group.
Justin, we might want to change one of our terms. If you told me that I was a short-term person, I'd go, what does that mean? Do I not have long to live? Do I not have to? I mean, some people could kind of not like that.
That's true. That's true. I guess I make assumptions too much.
Yeah.
With,
what are you? I'm a short-termer. Short-termer. Okay. Okay.
That's true. That's a good point. I never thought about that. Anyways, take your smartphone out, hold out your camera, and hover over that QR code there. There'll be a URL that pops up, and you can go to the CYREA webpage, and you just basically fill in your first name, last name, and your email address, and you will get credits for watching this broadcast today to go towards PHB. This is only for the CYREA members. If you're not a CYREA member, disregard that. There's a Be the Bank podcast that Richard and I put on every other week. It comes out. Episode number 5 came out today, actually, of season 5. So we've had well over 5,000 downloads for our podcast since we started this. So it's pretty popular.
It's the best podcast in the world.
It's the only podcast you should download. Absolutely.
That's right.
That's subliminal messaging right there.
That's right.
Stitcher, YouTube, Google Play, Apple Play, Spotify, iHeart, TuneIn. There's just like 40 or 50 of these podcast directories, and whatever one you like the best, we're on it. Look up Be the Bank, look for that logo, and you can subscribe and hear more of Richard and I making fun of each other. Richard,
right. Yes.
Almost every month, we look at the Black Knight Financial data. Black Knight Financial is a company that looks at all of the main mortgages across the country, and they do a ton of great analytics, and they show us what's happened in the past, they show us what's happening now, and they show us kind of where we're projecting towards as well. They had a lot of information in this report, Richard. I know you didn't have a chance to see it. It came out just a little bit ago, and I focused more on the home pricing this time than I normally do. I focus on the mortgages, but I thought the home pricing was kind of interesting, and we need to do a little bit of a reset and talk about this a little bit. So I'm going to show you some interesting things about supply.
Okay, cool.
So if you look at the following, I'm going to switch my screen over here. That's why I'm distracted. So you've typically heard of shortages in inventory across the country. It's been that way for a while since basically COVID, right?
Hmm.
So some of the homes listed for sale are starting to change, and this graph is showing since the 2017 2019 timeframe, which is actually a good time frame to compare to, because after that was pretty much when things started to drastically change for our real estate economy as far as supply and interest rates and home pricing and stuff like that. So there's a lot of crazy squiggly lines here, and if you just look at a couple of outliers that are, let's say, Vegas, Austin, and San Francisco, those are probably the places that you heard of during COVID that kind of took off as far as home appreciation, and they went through the roof. I think Austin was probably the most prominent one that you'd probably hear in the news, where there'd be
Right.
multiple offers and people would be just bidding 50, 60, 70, 80, $100,000 over asking price just to get the house. That those things did happen, and
Mhm.
those are overinflated markets.
Oh, is this telling us that things just never happened in Virginia Beach?
It's apparently, yeah.
I mean, Virginia Beach just did not make it, folks. Sorry.
Yeah, it looks like back in, I don't know if you can see my mouse on the screen, but I'm trying to see that. Is it 2018? There's that brown line there. That's kind of where it was at the 0% marker. And then it's just slowly driven down ever since 2018. And it picked up some steam in 21, then it just dropped back down. Picked up a little bit more steam, and then it dropped back down. So yeah, it's like it really hasn't had a lot of inventory that has continued to rise, has continued to dwindle, I guess, on a consistent basis.
One of my friends who's, let's put it nicely, not one of the most motivated people in the world. One of his favorite lines is, "Well, I think I'll start off slow and back off from there." Yeah.
That's good. I like that.
I think it's what the Virginia Beach market's doing. It's just kind of like going really slow and slowly backing off from there, kind of like sleepy.
Well, you can look at it a couple of different ways. So these are homes listed for sale, Richard. So it's safe to say that if you have a positive percentage on this graph, that you have an oversupply.
Right.
So the markets with the oversupply, meaning they have a lot of homes listed for sale that pretty much aren't moving. That's because it's Las Vegas, Austin, Texas, and San Francisco.
Right.
There's probably reasons for that. We'll get into that in a little bit. But those Phoenix and Boise are markets that have seen. I'm reading some stats here. They made it. They've changed so much so quickly, and that's what we're seeing on this graph. So I just wanted to show this to see, like, you have the zero line, which San Francisco ends up at the 0% line, and rest of the country is hovering down there in the we'll call it the listing shortages,
Mhm.
and who's an oversupply is the Vegas, Austin market, and San Francisco there for a little bit.
Interesting.
So again, another number of new listings. So this is looking at it from a different angle here. And there's just a lot less homes that are new listings versus the 17 to 19 timeframe. It's kind of what we're looking at here. So you see at the peak of we'll call it the COVID, it
Right.
hit 34% as compared to the 19 through 17. You see how it's normal here from 2017 all the way until you see the first drop that hits negative 34%. And that kind of makes sense. Like, it goes up, it goes down a little bit, but it doesn't fluctuate too much.
Right.
And then COVID hit, and obviously there was like no sales pretty much. And that's kind of where we're trending back to right now, is getting those numbers to be a little bit fewer sales. But it's interesting in some markets that are showing that they are, well, I guess we're gonna get to it here. So what I'm trying to say is that the overinflated markets are showing a home depreciation in price, and they're also showing a ton of inventory for sale. So it would seem like now is a better time to think about going to those markets to invest in. I'm
Right.
not saying the pricing is affordable yet, but it's trending that way.
Yeah. We haven't bottomed out, but we're getting there.
Yeah. So remember, they have overinflated so quickly,
Mhm.
and that caused an amount of money per house that is just unfathomable that quickly.
Right.
And so now it's cooling back down. So a lot of the people that you should be listening to were projecting this and saying, look, these markets are overinflated. You just stay away from them if you're investing, and just wait for it to correct itself, because it always corrects itself, right? What goes up must come down.
That's what I'm told.
Or what was the saying that you just said? If I could go slower, I'd go backwards. What are you saying?
Yeah. Well, no, it starts slow and then backs off from there. But
Start slow and then back off from there. That should be your saying, Richard.
you know, some days, but not often.
All right. I don't know why my computer's not letting me change slides here. Okay. So the month over month change in HPI. So if you notice, the blue colors are obviously trending in the rising direction, and the red numbers are in orange are trending down, and yellow is just kind of staying flat.
Right.
So you look at the West Coast and the southern states, it's not surprising that those are trending down in month over month. Housing price index, that's what HPI stands for. And this is obviously seasonally adjusted. They wanted to make that.
So it's interesting though, because you still get, so that would say that you still got an East Coast um, upward trend. And it would also say that Virginia Beach is not moving fast, but it's still moving up.
Yeah. So what I gather from this, Richard, is that in the Midwest and the East Coast, home pricing is staying the same appreciation that it typically does, which is just gradual, right? And it shows me the markets that are overinflated, which were on the West Coast and some of the Texas areas, that they're starting to cool back down more significantly to be more balanced. So I think eventually, if we look at this 6 months later, we'll probably see everything start to be more where it's supposed to be, like in the 17-19 timeframe, where things were just kind of what they should be. 2017, 2019, I should clarify that's what I meant.
Right. So this is also indicative of what we are told in the note world quite often, time again, which is that investing in the Midwest areas is good because they aren't affected by the ups, but they also aren't affected by the downs. So when you get a loan to value or an investment to value, you're not going to have as much fluctuation. You're not going to be invested in something that's overinflated now and tomorrow going to be worth a whole lot less.
Right. Yeah, one more slide here till we'll jump into some of the retirement stuff. So the change in median home price, here we go. We got some cities and states, listed up here. The blue is the change from the 2022 peak, and then the green is seasonally adjusted. So you notice some of the markets on the left side of the chart are more West Coast markets, and some of the markets on the right side of the chart are more East Coast and Florida, Atlantic coast kind of area. Anything jump out of you?
Yeah. So they didn't list Petaluma. I mean,
they didn't divide between East and West Petaluma.
Yeah, Petaluma should be, especially the East Side, West Side, should be one of the first places on our map, right? But
that's right.
Yeah. So I mean, obviously, San Francisco is what you would expect with a 16% drop there.
Yeah.
What I'm wondering is to what degree also this is sort of tech driven, because a lot of these cities like San Jose, San Francisco have got tons of tech. There's an article this last week about San Francisco having a 45% vacancy rate, and it's downtown office market. So why, what does that mean? It kind of also spurs the fact that people are wanting to move out into the burbs, sort of like Petaluma.
Yeah.
Petaluma is far, way out beyond a burb. But that in itself would deflate housing prices, in addition to this just sort of the normal cycle.
Yeah.
So there's got to be some sort of tie in there.
Well, we didn't have time to look at this together, so this is just a chart that I wanted to pull up and just show you.
It's a great chart.
Yeah. What the pricing's doing. So I didn't know it was that dramatic of the places like Austin and Vegas, where we knew they were overflated markets, that they have like a bunch of listings there and stuff's not moving. It's not surprising, but I guess this is just showing us, not that I was going to say the wrath of God, but that's a little too extreme. But it's Mother Nature, I guess, or is balancing the real estate market. And
yeah, I mean, if you look at the cities that have the lower change in median price income, you got Raleigh, Tampa Bay, you got Boston there.
Yeah.
Some of those are East Coast cities, so that means that there's quite a bit of similarity between the last chart you showed us, where you still got a slight increase in prices. They're sort of chugging along. Again, they didn't have the run up, so they don't have the run down.
True. Very true. All right. I think we've beat this up long enough here, Richard.
No.
So something that we don't talk about often is getting into the minutia of retirement accounts. So we just want to take some time today and just kind of discuss some stuff. Some of you on the broadcast right now may know a lot about retirement accounts or just know enough to be dangerous. And so we're just going to touch on a couple of highlights just to make sure you're aware of things. Richard and I started a fund this year that we've mentioned before, and we've sent out information and videos on that already. And by any means, if you haven't received that information, reach out to info@anbfunds.com. We're happy to get you the video and information on that if you'd like to find out more.
Is that the one where they send us money and fund our retirements?
Yes, I believe so.
Oh, okay. I thought
Just
that
kidding.
worked. Yeah.
Just kidding.
All right.
So the reason why I bring up retirement accounts, Richard, is because we've had a ton of positive feedback about looking for an investment, like a fund that we have structured, a debt fund.
Mhm.
And one of the best vehicles to utilize their buying capacity in a fund is a retirement account. We
Right.
see more often than not, retirement accounts are the ones that are funding these types of things because it's very passive. It's low risk, it's high security, it's just mailbox money as it should be, right? With zero responsibility, really.
Yeah, they start slow and back off from there.
So one of the interesting facts that I was kind of looking up today was 1 in 4 Americans don't even have a retirement savings.
Mm.
I guess it doesn't surprise me.
Yeah. Yeah.
Though,
Well, with the median income about $33,000 in the U.S., it's kind of hard to save much if you're only making that much.
there's a bunch of other charts and graphs that I could have pulled together, but it would be slighted because some of them have to do with like stock market type of accounts and other things. So I was just trying to take some general numbers and so I found a nice age group of folks that is not the only investors that we have, but a common investor that we have and that we see in the note space is the age 55 to 64 age group.
Right.
And they have a nice set of numbers here to go off of to really explore what they want to do with their retirement. So they're not at the retirement age yet, but they're getting close and they have a lot of opportunities to make some pretty consistent cash flow, low risk and high security. So they typically have about 57,000 in cash and savings.
Right.
They typically have over 200,000 in a retirement account savings plan. So, combined, they obviously are getting close to 300K in that type of value. Whether that money is in, a traditional IRA, 401K, or some sort of retirement account, that's about what the country is saying. And some of those stats were from 2019 because they only go through every 3 years. They do a survey on this stuff.
Right.
Excuse me, but that's where we're at on it. So, Richard, let's talk about different types of self-directed accounts. And let's first talk about, because there may be somebody on this broadcast that might not understand why are you talking about self-directed accounts? Because doesn't my retirement account at work, can it do the same thing that you guys are doing?
Right.
And Richard, you would say
no.
You would say no. It's simple. No, it's not the same.
Simple. Just say no. Typically, your retirement account at work is directed by a custodian or a fiduciary, and they have that as their responsibility, and they charge you accordingly. They'll charge you anywhere from 1.5 to 2.5 points to do that, and they'll ask you about different risk profiles and all sorts of other things. And help you give you guidance on your money. They do not like you to get in and muddle around and say, well, thank you very much for that guidance, but I want you to put so much money into X. So that's not self-directed.
Right. Some of them say that they're self-directed. They're really not self-directed in the sense that we're talking about. So when I say to you, Richard, hey, you can self-direct your retirement and anything you want. So if you had an account with, I'm not trying to pick on any one custodian, but the first thing that comes to mind is like a Charles Schwab or something like that.
Yeah.
So they may have accounts that you can do self-directed stuff in. So what can you do with that? Do they mean like you can self-direct it in, I want a more aggressive approach, or I want to buy these certain type of funds or stocks? or is it they truly can invest whenever they want?
Well, so let's differentiate a little bit here. And this actually, I didn't know this for a while. I didn't know a lot of things for a while. But anyway, this in particular. So if you go into a Schwab self-directed fund, as opposed to say Entrust or Quest or somebody like that, most of the custodians like Entrust or Quest
Or
are
New
not
View?
licensed to trade securities. So you can't invest in you can't use your Roth or anything like that to invest in securities. You have to do that through a self-directed company that has a license, a securities license,
Okay.
aka a Schwab or something like that. So you have to decide where you want to put your money. Do you
Right.
want, what? And you can. I've got money in both. I've got money in Schwab, and I've got money in other places because I want to do different type of investments. But that's a critical place to start out.
So the type of retirement account that we're talking about is primarily used for a real estate or a non-stock market type of investment.
Right.
And so we're going to go over some of these accounts here. So a 401k, you've all heard of that. That's kind of the normal retirement account you get when you work a W-2 job. It can be a traditional, and it can also be a Roth as well. And so, do you want to quickly explain the quick difference between a traditional and a Roth account?
A traditional or an IRA SEP.
Just say just 401k for now. We'll get into the different ones in just a second.
Oh, okay. 401k. So you take the monies and for a 401k, actually, you usually have a matching from your employer, and they'll to what degree, 6 cents, 5 cents, 25 cents, whatever, match the amount that you put in there of your monies, and there's a cap on what you can put in. In terms of a contribution limit, as you've got there, there's about $5,000 to $7,000 per year in a self-directed. I think you can put more than that in a 401k.
Yeah, in a 401k for a company, it's different.
Yeah.
You can contribute as much as you can stand it, and your
Right.
employer sometimes will match it depending on what their policies are for the company 401k.
Right.
In the self-directed sense, I didn't mean for that blue bubble to pop up and confuse an audience what we're talking about. When you have it in a self-directed custodian, like a New View Trust IRA, you can still have a traditional 401k and you can still feed to it, but you can only put so much money into it. And there are reasons why the government holds you back from investing in too much, because they don't want you to invest in real estate.
Right. And so, so I think though you were asking me about more of a SEP versus a Roth, and a Roth you pay the taxes on up front and don't pay taxes on thereafter. On a IRA, you don't pay taxes on up front, but as the investment comes out, conceivably when you're at a lower tax bracket, that's when you pay the tax.
All right, so you can have a 401k Roth and you can have a 401k traditional. There are other accounts that we're going to get into in just a second. So the Roth just means I'm paying taxes on it right now before it goes into my retirement. The traditional means I'm going to pay taxes on it in the future when I take those distributions, and I will be taxed as ordinary income in the future, whatever that number is.
Right.
So in the self-directed world, once you have it with a self-directed custodian, you can put up to $6,000 ish into that account. A Roth IRA. So when it comes to a 401k in the custodian's world of self-directed investments, you have a traditional IRA or a Roth IRA. They don't call them a 401k anymore. They say a traditional IRA or a Roth IRA. And that's why they're both about 6K in contribution limits. Now, if you're over 55, you get a bonus and you can put more money in there. So I wasn't going to go through and put all the stuff on there. I just wanted you guys to generally know what you do.
Right. So a question I quite often get too is, well, if the limit's $6,000 and Richard, it's going to, you want me to invest $30,000 just to buy a note minimum and or that same amount to invest in your fund, it's going to take me a long time to get there. How am I going to do that? And so what a lot of people will do is if they have a 401k or anything like that in their day job, you can tell that custodian that you want to take part of those funds and move them over to a self-directed IRA. So you can move 30 or 40 or 50,000, whatever you want to, of that money into a self-directed to build that up more quickly.
And they call it a rollover.
Right.
And so you can roll over to a like account or a different account. And so what do I mean by that? A like account would be like if I have a traditional 401k where I'm going to get everything is pre-tax that I put in there. I can still keep that like account with a self-directed account. I'm just going to have to know that I'm going to pay taxes in the future on whatever disbursements I take out in the future at the ordinary income tax rate in the future, whenever that date is. You can roll over and you can roll it into and convert it into a different account, except you have to pay a penalty, which I believe is 10%. And then you also have to pay taxes at that time. We are not CPAs. We are not financial advisors. We're just telling you that this is what happens. Some people, it would behoove them to pay a penalty now as opposed to paying a penalty later, and actually be cheaper for them to do it now. Some people choose not to do that, or then choose to split it and do it different ways. But that's how a rollover would work.
So for 25 cents or less, meaning that I will pay you 25 cents or less if you answer this question correctly. If I take my 401k and roll it into a Roth, am I going to have to pay taxes on that rollover?
You need to be more clear with your instructions, because this is what I just went over. If you have a traditional account, 401k traditional, and you roll it into a Roth IRA, you will have to pay taxes on it now, and you will pay a penalty now.
Right. I meant from a company, for a W-2 type company.
Same.
Right.
Same, but different.
Same, but different. That's right. Okay.
HSA, ESA. What do those acronyms mean, Mr. Thor?
HSA. I can't remember what the ESA stands for, but the HSA is the health one, right?
Mm-hmm.
It's what you set up for health costs. And you tell me what the ESA is.
ESA is Educational Savings Account.
Oh, that's right. Yes.
So some of them have a Coverdale Educational Savings Account. Some of them have a different type of name to them, but ESA is a general one. That's for your kids.
That's
so
right.
College fund, you can put up to $2,000 per child per year. I'm sorry, per child per account per year into their own ESA account. This is what I do for my girls. We put in $2,000 every year in contribution limits for it. Mm-hmm. And so they slowly build up their account. The HSA, you have to have a qualifying plan to be able to put that in there. I didn't put that disclaimer in there, but you need to talk to New View Trust IRA and get them to tell you all the specifics and the details about that. But that's what you can do. You can have a health savings account that you can use for medical purposes. That's going to be growing. You can invest in real estate with it, and it's paying. All the profits are paying for your health costs.
Right. Yeah. I'm glad you brought that up, because I actually get questioned on that so seldom. The ESA part of it. That's
oh yeah.
It just never comes up.
So most in Indiana, we have a College 529 account. Mm-hmm. And that is in Indiana a plan that is basically you can take pre-tax money from your paycheck, put it into your child's college fund, and it goes. Some sort of financial advisor manages it, and you can invest in the stock market with the money. This is the reverse of that, to where you can invest now in real estate world, and you can do it Roth style, to where you've already paid taxes on it when you put money in, but all the profits you make in the future, when you take it back out, zero taxes.
Cool.
Zero taxes. So that's the cool thing about the Roth. Mm-hmm. The SEP, as you alluded to earlier, and the simple IRA are different types of plans. We won't get into all the minutia of it, but basically on a SEP plan, an SEP, it's 25% of your compensation can go into it, up to $61,000. So that's a huge chunk of change right there. The simple IRA is a little bit different. It's just a different vehicle. We're not going to go over the differences from them, because quite honestly, I don't really know the specific difference of them off the top of my head. Richard, if you feel confident that you can answer it, but you can put up to about $14,000 in contribution for the simple IRA.
Right. So how does the SEP differ from a solo 401k?
Well, we'll go over the solo 401k next, but the SEP right now, you'll need to talk about the SEP if you feel like you're confident enough to describe it.
I do not. I'll just put it right out there. You just summarized about everything I know on the SEPs, and I suggest you talk with your local custodian for more detail.
Yeah, I think it has something to do with being self-employed,
Right.
because the solo 401k is more something that I'm familiar with.
Yeah, same here.
And so they also call it a solo QRP, a qualified retirement plan. So this is for the self-employed. The SEP and the simple, I think they have to do with being self-employed as well. I'm not 100% sure, but that's the reason why you can put more money in those. There is a caveat to them that you have to have. The solo QRP is 20,500, and I believe your employer can match it as well. So that's what's cool about being self-employed, is that you can have your own qualified retirement plan that your company can contribute to it, and then you individually can contribute to it as well.
Right.
So the question that we already answered is, can these invest in all types of markets? Yes, they all can. None of them are going to be. You're not going to be able to invest in something. Now, like you mentioned before, which you did a good job saying, is the securities. You probably can't do the securities because you have to have it with a specialized
You have to have securities license.
Securities license, yeah. So if your custodian, like a NewView Trust or somebody like that, has a securities license, you can probably still do that. I know some people do invest in the markets and with some of these custodians. That's fine too. But obviously, real estate, flips, rentals, short term in rentals, not short term living. Private lending would be like, Richard, I'm going to lend you X amount of dollars out of my retirement account so you can go buy this piece of real estate, or so you can go buy a note with it, or whatever. That's what private lending. Cryptocurrency is Bitcoin, stuff like that. Equity funds, debt funds. We have a debt fund, so you can invest in things like that. Tax deeds, tax liens, you can invest in stuff like that. And then the last thing we're going to touch on, we'll get to that on the next slide, will be trusts and LLCs. There's a myriad of other things, Richard, you can invest in. You can do oil, you can do precious metals, horses, just anything you can invest in with cash, you can invest in with these self-directed retirement accounts, with the exception of some of the things in the stock market.
How about jewelry?
Yes. Art. Yep. All that stuff. Most people use it to invest in real estate. That's just the truth.
Right. So I will caution you here, though, to all those listeners, if you do decide you want to invest in notes and do it through a self-directed RA, find one that knows about notes. They'll all say they will, but I've had several groups that I've dealt with that when you finally get into it, they clearly do not have an idea of what's going on. And it's painful. When you're trying to do a transaction with them, it can be very painful.
Yeah, if you have to explain to them what you're investing in and they still don't understand, they're probably not the right custodian for you to have your money with the type of investment that you want to invest in. So that's a good point
land contract. So do you have, what do you know about land contracts? And if they can't answer that question, then guess what?
Yeah, NewView Trust is definitely one that can handle all these things, and they're very good at it. There are other ones like you mentioned before, like Quest Trust, Equity Trust. Like they all know how to invest in notes as well. There are ones that are not as name brand, like you mentioned, Entrust, and there's is it the Cama plan?
Right.
Those ones aren't. I'm sure they do know how to invest in notes and stuff, but they just aren't like the top like 4 or 5 that come to mind as far as custodians across the country. Right. But there's a lot of them, Richard. There's like 50 or 60 of them that actually do this stuff.
Right.
But not a lot of them are name brand like some of the bigger names.
Right.
So I don't see any questions on the board, so we'll keep moving here, Richard. And guys, if you do have questions or if you wanted to give a shout out or something, feel free to chime in there. Let us know where you're at. We're happy to answer any questions or any questions in general about real estate note investing. We'll be happy to answer those as well. We can kind of wait till the end as well. So if you have something that comes to mind you want to know, go ahead and ask. Doesn't hurt to ask.
Nope.
The most common question I have for new account holders that are getting into this is like, you brought up a good point, Richard. If it costs $30,000 minimum to get into a fund, and I have a HSA, and I have that has a certain amount of money, I have an educational account that's a certain amount of money, I have an IRA that has a certain amount of money, But the smaller ones, maybe the health savings account and the educational savings account, because it just started off, I can only put $2,000 in them a year. That's not really enough to get into a fund or to buy a note, is it?
Nope.
So what do we do? Well, we can combine multiple accounts into a trust or an LLC,
Right.
and you have somebody else manage it. So you can actually commingle your retirement account, your wife's or husband's retirement account, your kids' college accounts, your husband or wife's health savings account, and you can push them all the money up into one company, if you will, and then you can use that bigger piece of the pie to go after and buy real estate. For
Right.
example, in your health savings account, let's say Richard, you got $6,500 in that.
Right.
Let's say your eldest has $10,000 in the educational savings account because you started 5 years ago and you threw in $2,000 every year. All right, so it's not enough to buy a note for either of them. Even if you combine the two together, that's still really not enough money to buy a note.
Right.
But you had the sizable retirement account that maybe you have or you and your wife have that you can combine together, and now you can push them all to a trust or an LLC. A trust is just basically a checking account that has an EIN number that somebody you name as a trustee manages and does the fiduciary responsibility and the execution of just anything that goes on with it. So basically, the beneficiaries are those three arrows right there: the piggy
Right.
bank, the books, and the medical sign. So they benefit from it proportionally. So if I put in 6,500 compared to the 241.5, I'm proportional at that percentage number to that. So like 3% or 2% in that case or whatever it is. And then the $10,000, yeah, that's going to be a couple percent there. And then the rest of it, 97% is going to be the piggy bank. So when they divest themselves of the investment, guess what? Everybody proportionally gets what they're owed. But the little guys benefit from having bigger guys with them. And so they can piggyback off of that venture and they can be a part of that investment. So that's how you grow the small balance ones.
Right.
And so as you're in the investment with a trust or an LLC, you can still contribute to those accounts, and then you can basically add back to them at the end of the year. And so the whole account will get bigger and bigger and bigger. So that 240 by the end of the year will probably be more like 300, and then add
Right.
your stuff to it at the end of the year is probably more like 320.
Right. And as we've talked about before, a very good investment strategy in doing this is to take your proceeds each month and don't pull them out, build them, and to buy a new note and buy a new note and keep rolling that over. And after about 10 years, you will have more than doubled the value of your account.
Yeah, we did a 10-year model on that, and I believe it was I want to say a 2.8x return
Right.
on the original investment without even adding into it. If you
Right.
add money and contribute to it on an ongoing basis after that 10 years, it's going to be even more than that. It might even be a 5 to 6x return based on your original capital.
Right. So it's a really good way to look at investing and being very passive and keep stuff going.
Yeah.
And growing.
So if you don't have enough funds, that's not an excuse.
Yeah. Right.
So typically when you will not be allowed to combine your account with somebody else's because it's a retirement account. You have to keep it, by itself. If you want to invest in something with a friend or a business partner or a spouse or someone that is a party that shouldn't be investing with you, the way they title stuff is like, okay, Richard puts in 50% of the purchase price and Justin puts in 50% of the purchase price, and it's both of our retirement accounts. They title it that way. They say Richard Thornton, blah blah blah, IRA 50% interest, and Justin Bogart, blah blah blah, IRA 50% interest. So you have this title that's like 400 characters long.
Right.
It just gets really lengthy. And so the more simple way to do it is just be like, okay, Richard and I are both going to invest in this trust account. We're going to make somebody else the trustee where they're actually handling all the paperwork and the documentation and actually moving the money and collecting the money. And then that's how you get around it. So you can commingle accounts with multiple people. You have to do it in a proper way, a structure like a trust or an LLC.
I was just going to say, could you do that with an LLC also?
Yep.
Yeah, that's what I think.
As long as somebody else is managing it and not
Right.
you or the other beneficiaries, absolutely.
And as long as there's, again, this is where you need to talk to a certified person, but they can't be a spouse, they can't be a brother, they can't be a sister, they can't be the whole laundry list of people that they can't, of the relationships that they cannot have to you.
Correct. Yeah. Yeah. It goes up, down, and out, something like
Right.
that. There's a way that they do it. But yeah, you're right. So I don't see any questions on the board. We're doing pretty good on time here.
Kind of a
So,
quiet day today.
having a quiet day. It's
That's
quiet
all right.
March. March Madness is upon us here in a couple weeks. So
Mm.
right before the storm. We buy first liens, as you guys very well know. We buy land contracts or contracts for deeds, sometimes they call them, note and mortgages, note and deed of trusts, lease options. As long as they're first lien and residential, that's what that's what we want to see. So take your smartphone out. You can hover over this QR code, and that will get you to, our note quote form where it currently sits. It will change in a little bit, but you can always get to it at this QR code. And if you're going to watch the replay, you can just pause it, hover over that, and kind of just pull up a little link on your phone, and then you can get to it that way. So we buy
Right.
all those. We're looking to buy them. If you want help on buying them, whether you need somebody to partner with you on it, we're open to that. Or if you need help kind of understanding, is this a good deal or not? And then we can give you our feedback on it. All right. So the last part of my slide here, Richard, before we get to the Q&A here, is the next time we're going to have a broadcast is going to be April 12th from 6 to 8. We do have social media for American Note Buyers. If you followed us as Bright Path Notes, you don't have to do anything. You've automatically been converted over. Facebook, Twitter, Instagram. Richard and I both have our own LinkedIn pages. So if you're on LinkedIn, just go ahead and connect with us. Our direct emails are Richard or Justin at anbfunds.com. And thank you to our sponsor, American Note Buyers. Hey, that's us.
Mhm.
So I'm going to turn off the PowerPoint quickly, Richard, and then get over to our little Q&A.
All right. See you at the party.
We will do our little outro. For those of you who stay on, if you got questions, and we'll be glad to answer them.
Okay.
Hey, I know that guy. You're Richard Thornton.
Yeah. Yeah, about that. So somebody says our web form is down.
Our web form is down.
Yeah, Facebook user.
Go ahead and let me know which form did you. Whoever sent that message in, let us know if that was like the QR code that you did, or if you went to the website. The website form I don't think works quite yet on our A&B Funds webpage. So that's why we have that QR code. So if that QR code is down, then I need to do some research on why.
Yeah, so you can send it to Justin at anbfunds.com.
Yep. Yeah, so go ahead and chime in there. Our Facebook. We don't know who you are because on Facebook you have to give permission for your picture and your name to show up on streams like this. So that's why we don't know who you are. We would love to know who you are.
That's right. And thank you for the help.
Yeah, thanks for pointing that out because
we have
thought it was working
in systems yet, so
I was told it was working.
Yeah, exactly.
All right, Richard. What digressing here from today's home pricing changes, inventory fluctuations in certain areas, and retirement accounts? What's your digression here as we close out the?
I don't know. I mean, what I'm finding interesting is that we're still bouncing around. There has been no huge fall as predicted. I don't know if you've been reading about what the Fed's been trying to do, but even though they've been trying to taking actions that would usually affect the employment rate. The employment rate is now the highest it's ever been. So there's some very weird things going in the market that people just cannot explain. I mean, if I think of all my business school explanations about cause and effect, they're all broken. None of them are working right now. So, a lot of people are scratching their heads, I think, saying, where do I go and what do I do?
Where are you going to go? And what are you going to do, Richard?
Really? I'm going to invest in the A and B funds.
That's the
for
easy
my
answer.
retirement.
I am reaching out to our Facebook user here. And they had mentioned that it's a sign up for our email list. Link is not working. So thanks for letting us know that wasn't working. I'm going to work on that and get that fixed for us. But if you email us at info@ambfunds.com with your information, we'd be happy to put you on our mailing list if that's what you were trying to do, or just connect with us in any way. Please use that email, info@ambfunds.com, so we can get back to you as quickly as possible. So thank you for researching that for us. Appreciate it. Richard, my takes were I was not surprised after seeing the data, but it kind of snuck up on me that we were cooling down in some of those markets so much
Right.
on the West Coast, and that the inventory actually is a surplus as opposed to a shortage in some of those areas, which it does make sense now that we think about it. Those were overinflated markets to begin with, and now they're cooling back down, and everything is coming back down to what normalcy is, or trending in that direction. As to say, they're still overinflated.
Right.
Doesn't mean we're going to go rush over there and start investing in there anytime soon. It just means that, hey, this is a good sign. So the areas in the Midwest and the East Coast that have kind of stayed consistent, we're not going to see much changes with those at all. I can't imagine seeing a dramatic change up or down. Do you?
No, I can't. And I still think that that's a good steady Eddie place to
Yep.
invest. I mean, Midwest isn't going anywhere. And so nor are the coasts, but they're just going to be a whole lot more volatile given what's going on.
Okay. I looked at the interest rate before we got on the call, and we were about 7% nationally at a 30-year mortgage conventional.
Okay.
7.07. If you want to be,
that's getting up there.
Yeah, and a month or two ago, I think it was down to closer to 6.
Yeah. What I think is interesting is that the markets that seem to have good, strong employment aren't falling as much. Like you can say the San Francisco area has dropped 16%, but a lot of people have got jobs here, and I'd really have to look through the leaves on that, because I couldn't say that that's true of Petaluma here. In Petaluma, we've probably got maybe a 2 or 3% drop, but that's it. But then you look at places like Bend, Oregon, which is really quite nice, quite upscale. You got a lot of growth there, but there's no real underlying jobs there, because we've been looking for another house up there, and prices are dropping like rocks. I mean, they're going from 700 to 500 real fast.
Wow.
Yeah, exactly. Exactly.
Makes a big difference. Well, Richard, we are out of soap, as our mentor would say.
Okay.
And thank you for everyone for staying on and providing some questions there. We appreciate the Facebook users' help. We will find out who you are and thank you over the internet properly, but we just don't know who you are.
Right.
We appreciate that. And you guys have anything you want to bring up for the next time, we're happy to go over deals with you on the call. We just thought this was a good time to go over retirement accounts, since we have a lot of people investing with their retirement account right now. For those of you that are unfamiliar with it, that you can invest in real estate with your retirement account, we hope this was very helpful to you, and reach out to us or New View Trust IRA, and we'd be glad to help you and move you in the right direction. So we will see you back in April.
All right.
Bye.
All right. Talk to you tomorrow.